we talk about completing tests specifically in the sales transaction cycle. So we're testing the detail of the balances. So when we're doing balance related audit objectives, these are our, I don't know, is there 7 or 8 of them? But so we're looking for the existence of the balance that we're testing, completeness, accuracy, detail tie-in, cutoff testing, classification, realizable value, and rights to it, and then presentation. So rights and presentation are two separate. I probably should have a little comma in there. And then this is, again, the different phases, which we'll talk a little bit about on the next slide as well. But these phases tie back to kind of the audit process itself. So we identify the significant risks and assess risk of material misstatements, but now we're talking specifically for accounts receivable because we're in the sales transaction section. Set performance materiality for accounts receivable, assess control risk for the sales and the collection cycle, design and perform tests of controls and substantive tests of the transactions of the sales and the collection cycle, design and perform substantive analytical procedures for the accounts receivable balance, design test of details of the accounts receivable balance and the related disclosures to satisfy the balance related audit objectives. And again, what audit procedures are we going to use? What is our sample size? What items will we select? And what is the timing? So to kind of summarize some of that first phase, we're going to consider the client's business and their industry risk, or their industry, to determine the risk. So again, like what's going on in the industry, what's going on with that particular company. If there were significant things, like maybe one of their major customers we know is having business issues, maybe they're getting ready to declare bankruptcy, like that could be something that we would obviously consider, and it would change our level of risk and change what we test. Set performance materiality. So if accounts receivable, generally speaking, if it's a customer that extends credit, or I'm sorry, if it's a client that extends credit to their customers, so, like think of a major manufacturer, if they're billing out their customers as they sell them product, accounts receivable is going to be a large current asset to them and a large potential risk. So then in that case, the performance materiality would be high. If it's a company, like the Dollar General or something that doesn't actually bill customers out, people pay as they come in, obviously then that's really not even going to be, accounts receivable wouldn't even be an issue. The auditors also want to consider the internal controls. So what, do they have good controls over the cutoff of when sales are being recorded, their allowance for doubtful accounts? Do they have control procedures where they're, you've got segregation of duties to help prevent embezzlement? You've got independent checks, things like that. Then phase 2, we perform the substantive testing and the substantive analytical procedures, again, over the accounts receivable and sales process. Then phase 3, we would perform the actual test of details of that accounts receivable balance. So when we get into that test of details of that accounts receivable balance, we're really going to start probably most likely with their aged trial balance. So an aged trial balance is going to give you a list of all of their customers that have invoices outstanding, as well as the aging of them. Are they current? Did they just send them the invoice? Are they maybe over 30 days, between 30 and 60? Are they between 60 and 90 days, or are they over 90 days? So that's going to really kind of clue in the auditor, again, of like that allowance and the net realizable value of the accounts receivable. So they'll test those to make sure, of course, that the balances that are included are true and accurate and complete. But then they're also going to look at that allowance to say, do we have a decent amount in our allowance for bad debt to cover these accounts that are over 90 days, because those are probably the most likely ones that are going to be written off. So their balance related objectives, again, like I kind of mentioned some of them as I was going through that trial balance, but existence. So we want to make sure that they truly exist, so that we see them on the trial balance, but are they really real? So then how we test that is by sending out confirmations to the customers. Are they complete? So does it have everything that should be recorded in that proper period? Which again kind of goes into cutoff. So completeness, is there everything, all the invoices that should be in that period are there? And then cutoff, did we properly cut it off so that we didn't have sales that were happening on the next day that are being thrown back into the the prior year, or vice versa? Or if we're looking at our FOB shipping point versus destination, or all of those goods counted when they should be, or sales counted when they should be. And then also consider sales returns, because again, we want to make sure that those are in the proper period. And then we also want to make sure that there's not a large amount of returns that are coming in right after the year end, because that might indicate that there was some stuffing of their product, shipping their product out to customers and then allowing them to return it. Accuracy, we can test by just footing the accounts receivable ledger, or the aging, to make sure everything ties out. We'll also test the accuracy of those invoice amounts when we mail out the confirmations, or send out the confirmations. Classification, is there any large credit balance? Because in your accounts receivable should be a debit balance. The customers should owe you. What if there was some reason that we owed that customer? Again, if it's minor, if it's like, oh well, they returned some product and there's a credit on their account for a minor amount that's going to offset with the next invoice, no big deal. But if it was large, the auditors would say, well, that's a liability, because you either owe those people back, or you either got to cut them a check for that money back, or you have to replace the product, or whatever the reason it went negative for. So if they have those credit balances, the auditors would want those to be shown as a liability, not as a asset reduction. Presentation and disclosure, is there any sales to related companies, or any issues, with does the president of the company own another company that they have a ton of sales to? Obviously, they're going to have to disclose all of that stuff. And then the realizable value goes back to that balance in the allowance for uncollectible accounts. Does that seem reasonable? Are we even though we don't know what accounts we're writing off yet, does it seem like it's a reasonable amount to show as our net accounts receivable? And then rights are included in here too. Normally, your company has rights to their accounts receivables, but every once in a while, companies will pledge those on a loan, or they'll sell them off or factor them to get the cash now. So you just would want to make sure that that hasn't happened, and these accounts receivable are truly going to come into the company. So then how does the auditor go about confirming accounts receivable? Because that's probably the most common way to get a very reliable source of evidence. So a positive confirmation is where we're going to send out a request to the customer to confirm the balance that's showed. So normally, again, on those confirmation, it's going to list all of the invoices outstanding directly from the aging for that particular customer. They're going to look at it to see, is this correct, sign it, and then mail it back in. Now, if there was any discrepancies, there's always a spot on there to say, no, I already paid this invoice, or no, that's not the right amount. So there's always a spot to show any discrepancies. So, but the problem with the positive confirmation is you expect those people to mail it back to you. So that's the goal. You mail it to them, and they're going to mail it back to you. If they do not mail it back to you, then the auditor is going to have to come up with some other method to get comfortable with that balance. So those alternative procedures might be to look at subsequent cash receipts, because again, if you're performing an audit at the end of December, the auditors are probably in there around February, so that customer could have paid by then. So you could say, okay, yeah, they didn't confirm it back when we mailed out the confirmations, but here they've paid us. Again, if they haven't paid yet, test it back to the actual sales invoice, to the shipping documents, to their sales order, whatever paper trail the auditor can go through to think that, okay, yes, I believe this invoice truly does exist. Negative confirmation is a little bit easier because they don't have to mail it back to you. So the negative confirmation says if there's no response, then everything's fine and you're in agreement with all these balances listed there. So they only send a response back if they disagree with the balance or they have some sort of discrepancy. So the advantage is that they can do a larger sample size because there's no return postage included. The disadvantage is you don't know, just because they don't mail it back to you, does that mean that they agreed or does that mean that somebody didn't even open it? So you don't know 100% for sure that they're agreeing with you. So there's only certain times that would be acceptable. If your accounts receivable is made up of a large number of small accounts, so like one account isn't material, it doesn't really matter if they don't get back to you. If that assessed control or inherent risk is low, so you don't really expect there to be fraud or to be anything that they're covering up. If we also expect a low exception rate, so again, maybe we feel very comfortable with their internal control procedures, they're a client we've had for years and there's never been issues. And then if there's no reason to believe that those customers would not adequately review the request. So again, it's if it's businesses that have been around and they feel comfortable that yes, I think the customers of the client are responsible enough to open their mail, see it, and actually give it the attention it deserves. So some more details again regarding those confirmations again, because it's probably the most important way that we confirm the balance in the accounts receivable. The timing of the confirmations, it should be as close to the balance sheet date as possible. There are times when you can go back to an interim date again, that if you were very comfortable with the balance and you didn't feel like there was much risk, they could go back to an interim date and do it. But primarily you want to do it as close to the balance sheet date as possible. They need to make the sampling decisions. So how big of a sample should we do? And a stratification of those balances so that we're picking the higher dollar amounts and also picking at all levels. So not only current but past due. So again, kind of covering the entire accounts receivable. And the size again goes back to the risk, the control risk, the inherent risk, the type of confirmation. Again, if it was a negative confirmation, we send out more. If it's positive confirmations, we send out less. And the performance materiality, like we said, it's already probably high for a company that does bill out. The auditor is responsible, so the client provides them with the mailing address. The auditor then is responsible for actually mailing the confirmations and getting the confirmations back. So once they've gotten the address from the client is kind of out of that loop. The auditor also would follow up on any non-responses. So they would use some sort of alternative procedures, just like I talked about on the last slide. So look at subsequent cash receipts, invoices, and shipping documents. If the client could say, hey, this customer has been emailing me about this invoice and here's proof of it. So even though the customer didn't reply, they can say, here's some correspondence. Ordinarily, they don't look at that, but in this case, if the person did not confirm and there was some correspondence, they could look at that. Then they'll do an analysis and prepare a conclusion. So they'll consider the timing differences. Like a lot of times that's what, like say you get the confirmation back and the people say, oh, no, this invoice is no longer outstanding. I paid it. Well, maybe that check came in to the company and was processed after they gave you the addresses and you know what I mean? Because there's obviously a lag, especially if you're using the U.S. Postal Service and actually mailing these confirmations. There definitely can be a timing lag. So you got to take that into consideration. Or again, maybe the client said, well, no, I don't owe this because I returned those goods. And again, that could be due to timing or processing of that return. Or maybe it's a disputed amount. They charged me too much. I had a contract at a lower price or something along those lines. So you'd look at all those discrepancies and again, consider the nature of them and does it increase your risk or not. And then you'd make that conclusion. So the conclusion is basically that you're going to generalize the entire population of these invoices from the sample that you have taken. And again, considering the nature of those discrepancies, because some discrepancies are really no big deal. they're just the nature of business, and some of them might not be. Okay, so that is our completing the tests of the sales and collection cycle.